Welcome to The Explainer. Today, we're tearing down GT Capital's mid-year earnings report for 2026. And wow, is there a lot to unpack here. We're going way beyond the surface-level press releases to uncover the real economic stories hiding behind the raw numbers of this massive Philippine conglomerate. If you really want to understand the current headwinds and tailwinds facing the broader economy, looking at a holding company like GT Capital is honestly one of the best ways to do it. So let's dive right in.
Right out of the gate, we've got to address a massive shocker in the financials. GT Capital's overall consolidated net income took a severe 17% hit. We are talking about a drop of over 4.2 billion pesos compared to the first half of 2025, falling from roughly 24.9 billion all the way down to 20.7 billion pesos. I mean, for a blue-chip conglomerate, a double-digit contraction in net income is a pretty loud alarm bell.
So what exactly went wrong? Well, spoiler alert, it actually wasn't bad news across the board. To figure this out, we need to do a classic analyst's teardown. GT Capital is essentially the sum of its parts. By separating this giant into its core operating pillars, automotive, property, banking, and infrastructure, we can see exactly which engines are stalling out and which ones are keeping the whole holding company afloat.
Section 1. Auto sector. A bumpy ride.
Okay, let's start with the biggest drag on the portfolio right now, the automotive sector. This segment is driven predominantly by Toyota Motor Philippines, or TMP, which is usually the absolute crown jewel of GT Capital's revenue stream. But man, looking at the sheer scale of the contraction, TMP went through a really painful slump. Sales dropped nearly 15%, falling from 135.5 billion pesos down to 115.4 billion. And the real pain? That was felt on the bottom line. That revenue drop, combined with some serious margin pressures, dragged net income down by a staggering 32.9%. It went from 12.4 billion pesos down to just 8.3 billion.
So why the drop? Well, management actually called this out in the SEC filings as a bit of a perfect storm. First off, slower overall market demand really hit their wholesale and retail volumes. Second, they faced a less favorable model mix compared to last year. And third, this is critical. There was a severe shortage of electrified and hybrid vehicle inventory right when consumer demand for them was absolutely peaking. On top of all that, a weaker Philippine peso, driven by slower GDP growth and geopolitical fallout, severely squeezed their gross profit margins down to 13%.
Here's the crazy part, though. As bad as that 32.9% net income drop sounds, it literally could have been so much worse. It is absolutely worth noting that this decline would have been way steeper if not for a substantial 2.5 billion peso cushion. This boost came from tax incentives utilized by TMP through its participation in the Philippine government's Comprehensive Automotive Resurgence Strategy, or the CARS program. But this perfectly illustrates the absolute resilience of a market leader. Despite the bumpy ride, the margin squeeze, and the frustrating inventory shortages, TMP actually managed to grow its market share to 49.3%, up from 48% last year. How did they pull that off? Because they outperformed a broader automotive industry retail volume that shrank by an even faster 11.8%. Basically, they took a smaller slice of a shrinking pie, but their slice is now nearly half the entire market.
Section 2. Property, a one-time mirage.
Moving over to the property segment, GT Capital's real estate arm, Federal Land, is putting on a fascinating illusion right now. It perfectly highlights why we always have to read the footnotes. Check this out. Core real estate sales dropped 16.5% as existing projects neared completion and turnover. Yet somehow, net income didn't just grow, it exploded by over 1,100%. Now, as an investor, when you see revenues dropping but net income up 1,154%, your immediate question should be, okay, what's the catch? Let's pull back the curtain on this. The reality behind this staggering 3.99 billion peso net income is a massive one-time gain from an asset sale. This was not driven by some sudden miraculous surge in selling condos. Nope. Federal Land sold off assets and used the proceeds to settle debt in April 2026, and that move drastically skewed the consolidated net income upward. Now, if you strip away that one-time windfall to look at the actual health of the core business, well, the picture changes entirely. Federal Land's core net income actually dropped by 44.3%, ending at just 177.4 million pesos. This was largely due to lower top-line sales and a critical lack of new project inventory, coupled with winding down contributions from joint ventures like Grand Hyatt Residences. Section 3. Banking and Infra, the Anchors. So you're probably wondering, if auto is shrinking and property is leaning on asset sales, how on earth is GT Capital still posting over 20 billion pesos in net income? That brings us to our third pillar. While the auto and property segments faced some brutal headwinds, GT Capital's banking and infrastructure arms served as the portfolio's absolute stabilizing anchors. Metro Bank was a glowing bright spot here. The bank posted a rock-solid 12.8% growth in net interest income, jumping from 60 billion up to 67.7 billion pesos. This highly profitable growth was driven largely by strong expansion in both their corporate and consumer loan portfolios, which includes things like mortgages and credit cards. Metrobank practically kept the whole ship steady all by itself. They generated an impressive 24.9 billion pesos in net income while expanding total assets to 3.92 trillion pesos. And crucially, they pulled this off while maintaining incredibly healthy asset quality, keeping their non-performing loan ratio down at a very low 1.8%. Seriously, that is textbook responsible banking during uncertain economic times. And over on the infrastructure and utility side, Metro Pacific Investments Corporation, or MPIC, delivered some really reliable, predictable stability. MPIC grew its core net income by 6.2%, bringing their total core contribution to the group up to 15.9 billion pesos. When your consumer-facing businesses are struggling, this is exactly why you want strong utilities anchoring a conglomerate portfolio. That roughly 6% infrastructure growth, it was fueled mainly by two key drivers. First, improved power generation revenues from Meralco, whose core net income contribution was up 6%. And second, newly implemented toll rate increases at the Metro Pacific Tollways Corporation, which managed to offset slightly lower traffic volumes to boost their income contribution by 7%. Section 4. Investor Takeaways. What's next? All right, so we've torn down these deeply disparate parts, from the real struggles in auto to the one-off mirages in property to the rock-solid foundations in banking. So what should you actually pay attention to for the rest of the year? Here are your key monitorables. First, keep a very close eye on the foreign exchange rates. If the weaker peso continues, it's going to keep eating right into TMP's auto margins. Second, remember that Federal Land's explosive net income was a one-time event that will not repeat. Their core operations desperately need new inventory to bounce back. And finally, you have to watch for the impact of new vehicle model launches. Which leads us to the ultimate, most critical question for the rest of 2026. With highly anticipated new models like the next-generation Tamarao and a refreshed Camry launching soon, can GT Capital resolve its crippling hybrid vehicle shortages and engineer a dramatic automotive turnaround? Look, the demand is clearly there, and their market share is dominant. But will execution on inventory be enough to restart this conglomerate's main engine? Keep your eyes on those delivery numbers in Q3. Thanks for joining me on this explainer, and keep learning.